Hi everybody, welcome back. In this section we're going to take a look at money and banking and how money and banking work together. As you can see, I've improved my layout a bit. You're not having a view of my bedroom, and so hopefully it'll make it a little bit easier to watch. So what I suggest is we get right into our lecture on money and banking. The objectives of this lecture are multiple. So what we're going to be doing is we're going to be looking at understanding the definitions of money and its use. We'll look at how to understand the principal measures of money in an economy. And what we'll do is we'll look at the measures that are used principally in Europe and in the United States, although similar measures exist obviously in other countries. These are referred to as monetary aggregates. We'll then look at the role of banks in the economy. I mean, banks play an important role in financial markets, obviously, but they play a much larger role in the economy, in particular with monetary policy that we'll look at in a week or two. We'll try to understand the balance sheet of a bank and how a bank operates, and the different roles and different types of assets and liabilities in a bank, and why they're extremely important in understanding how money is created and managed in an economy. And we'll finish off with how money is created and the role of something called the money multiplier, which helps us determine how easy it is to grow the amount of money in economy, something we have to manage very, very carefully, because as we've seen in the last section, if we have too much money, if we grow the economy too fast in terms of the amount of money that we put in the economy, well, imagine, if you will, everybody receiving tons of money in their mailbox. Obviously, if consumers have tons and tons and tons of money arrive in their mailbox, producers and sellers are going to respond, and they're going to basically say, whoa, if everybody has all this money, why don't we just increase prices? So prices will increase as the amount of money that's chasing the number of goods increases. If we have a lot of money chasing too few goods, well, sellers will just increase the price. And so money can stimulate inflation. So money management is extremely important. But before we get to monetary policy, let's just try to understand how money works. So what is money? And to understand that, we have to get a really good understanding of what we mean by money. We're not just talking about bills with somebody's name on it or coins. There's a whole bunch more in understanding what is money. We'll take a look at that right now. So money is defined by its usefulness. If you look at money, we're concerned with the concept of usefulness. And money is useful because it allows us to exchange goods and services. It allows us to buy goods and services. It allows us to sell our services to other people. That's the utility or the usefulness of money. Before money existed, we used barter, where you would basically see one person getting together and exchanging goods and services with another person. So let's just take a look and see why barter was probably an inefficient way of actually managing money. If we see here, we're trying to exchange between two people. If we're lucky, maybe what the person on the left is selling is what the person on the right wants, but it's not often the case. If you want to exchange if you want to give somebody an automobile, what do you exchange it for? I mean, what would be the equivalent in terms of the number of kilos of wheat or something like that? And how do you go about making such an exchange in a barter economy? So barter is basically trading one good or service for another. and I'm sure you've all seen this, or even maybe partaken in barter. In an economy without money, an exchange between two people would involve a double coincidence of wants. And so this is getting back to what we were saying. It's basically saying we have one person over here, and they say, I want, let's say, a box of goods and services, and they have, I don't know, something to give, maybe a container of oil. And on this side, we've got somebody who wants a container of oil and is ready to give a box filled with what the other person wants. And so we can have an effective exchange. And this is called the double coincidence of wants. The wants coincide, and everybody's happy, and things work out pretty well. Today, this is a really good example, and some of you have maybe heard about this, where people are literally swapping out their homes. And you get to see my skills as an artist here. People have ways to exchange their homes. Let's say somebody wants to go visit Florida and somebody else lives in Paris. Well, what happens is that instead of going and buying a hotel room and whatnot, well, they just exchange the use of homes, home swapping, that exists. The other exists in what's called professional services, and this is often referred to as courtesy. Professional courtesy is when, for example, one physician will provide services for another physician's family and vice versa. Now, this raises a bunch of tax issues, and governments don't really like swapping and bartering very much because it's very hard to control. Simple example, when I was a graduate student, I worked and I was in the university, and the university per year maybe cost about $20,000 for fees. Of course, I had no money, zero money available to pay for that, and so I worked as a assistant professor. And as an assistant professor, the school paid me the huge sum of about $700 per month. Now, that was very nice. So I was receiving the $700 per month, which would not cover the $20,000. So in addition to that, they gave me what's called a stipend. A stipend was a fee stipend, allowed me to have the $700 plus have a stipend to cover my fees, the $20,000. So in reality, I was getting paid $20,000, which I was just using to pay for my fees. I never really got the $20,000. They just allowed me to enroll free of charge in my classes, and also got $700 a month. So free enrollment plus $20,000. No, excuse me, that covered the $20,000 plus my $700. So I was getting $700 a month, and I had free enrollment that was valued at $20,000. Now, you can be surprised that Uncle Sam did not like this, because I was really receiving $20,000 worth of courses, but I was only making $700 a month. And so Uncle Sam said, no, Dan, you must pay tax also on the value of the $20,000. So your income, which was $700, plus the value of the free enrollment, which was $20,000. Obviously, many people got upset by this change in the law, and it was not accepted. Thank God. So barter creates situations where people exchange goods and services, but we can see over here in the example, there's no tax being done. Now, legally, you're supposed to declare that and pay tax on it, but it often escapes tax. So if we go back to money, money serves four important functions and helps solve problems associated with barter. The first of money is a medium of exchange. A medium of exchange. This means that we can use it as an intermediary. Instead of, for example, if we go back to the last example, we had a person that had a box full of something and a bunch of oil in a container. Well, instead of swapping or exchanging the two items, I exchange this for money, and I can exchange this for money, and then I just trade the amount of money in the economy. So I don't need to have an exact match. I could say maybe trade this for $100, and this is equal to $100, and I don't need to go out and find this person until I'm ready to buy the barrel of money. I can easily sell this to somebody else who doesn't have a barrel of money but wants my box. So a medium of exchange is an intermediary between a buyer and seller. It must be widely accepted. It's got to exist for everybody in the economy. Everybody has to have access to it. Everybody must believe in it as a method of payment. Interesting point, in the United States, long time ago, different types of methods of payment, different monies existed in every state. There wasn't one US dollar. There were many forms of money in the economy. And what made the dollar more important over time was that it became more widely accepted. And obviously we can exchange one product of money for money and then exchange the money for something else. I don't have to go out and find the perfect match between needs and wants. I can have an imperfect match. Money is a store of value, so I can put the money aside and it's still worth something in the future. If I barter, I can get a product in exchange. I can store it, but if it goes out of style or decreases in value or demand falls for that product, I've lost value. So money is something you can keep and use later without significant change in the value, because we know what? We know that if we have a bunch of money sitting around in my house or in books, because I'm afraid people find my money, whatever. Well, with inflation, the value of all of this is going to drop over time. My money buys less. So yes, it erodes the value of money, but there still is a store of value somehow. Third, money is a unit of account. We measure the value of something in terms of money, in terms of the currency we use. So we'll measure in euros or dollars or yen or whatever. And lastly, money is a standard of deferred payment. I can consume a product today, emit a bill, and pay in the future. I don't have to do things at the exact same time. So commodity money has existed for years, and we gave, there are many even in the past. People used to walk around with literally buckets of shells and use them as a way of money. You would keep the shells. You would say, okay, it costs so many shells. You'd get a bucket of shells. You'd have your bucket full of shells, and you'd walk around and give shells to somebody in exchange for something. You'd sell stuff in exchange for shells. Silver was used, tea was used, tobacco, gold, copper, cocoa beans, alcohol, and salt, surprisingly, was used. Now, these are just some examples of commodity money. Obviously, what's important about commodity is factors of rareness, can it be easily duplicated, etc. And so commodity money actually started to disappear. I think the earliest traces of commodity money falling out of use was even in the 15th century. But paper money and other types of money came about much later. We then had what's called commodity-backed currency. And commodity-backed currency is basically saying that, you know what, we have a paper bill here, but if you ever find one of these, it's very unique because this is blue. It's a blue symbol, and this is called a silver certificate. And that means if you find one of these, you can exchange that $1 bill for its equivalent in silver. And today, it's about 2 grams of silver equals for $1, if I believe, unless I'm mistaken. So you can actually get a commodity, which in this case is silver, for the dollar. And that means it's a commodity-backed currency. Now, what's nice about that is that as we print a certain amount of money, well, we have to make sure we have the silver to back it up. We have to be able to exchange the silver for the money that we're creating. So it kind of limits the amount that we can produce. I mean, granted, the price may change, but at some point, we're basing the amount of money we're producing on a rare item, which is silver. Fiat money is what we have today. And fiat money, and you've got some examples here to your right, is basically trying to resolve the problem of commodity money. Well, commodity money, as we mentioned, is difficult to use. It's cumbersome. You have to carry around salt and shells and gold, which can be heavy. And so it resolves the issue of commodity money. Fiat money grew as economies grew over time, and basically it's a piece of paper, and you see all the examples over here. You see many examples that the government declares to be quote-unquote legal tender, and that usually is written on the money. This paper has no intrinsic value. It's just paper. You can print it. And granted, some of it's very technologically advanced paper, but it's just paper. You can pay your debt with this because it is legally accepted as money or fiat money. Now, the risks with fiat money do exist. Obviously, it may be easy to copy. So we have people that make counterfeit money and try to make counterfeit money. It is not in its nature limited. You can print as much money as you want. We saw that with Venezuela in the last module. Governments can print as many bills as they want. There's no inherent rarity. So we have to manage the rarity. We have to make sure we don't print too much and let things get out of control. And obviously, it's not worth anything. It's just paper. So we have to maintain the perceived value of it over time. If we print too much, the value will fall. So now we'll go into the questions about measuring money. And measuring money looks at specifically monetary aggregates, how we measure the amount of money in the economy. So let's take a look at that. So some of the definitions of money that exist require us to understand a very simple concept in economics, that of liquidity. And liquidity basically defines how quickly we can use a financial asset to buy a good or service. So if I go down to McDonald's and want to buy a hamburger, this is very, very, very liquid. We're talking about a very liquid asset would be coins. I can exchange them for a good or service very quickly. I also maybe have a savings account, but my savings account is much less liquid because I can't give somebody my savings account. I have to go out and get cash before I can use my savings. So I have to transform savings into cash and then use the cash. The same is true with, for example, stock in a company or a bond. I can't really give somebody a little piece of my stock in exchange for a hamburger. I have to go sell my stock. I then have to recuperate the money, and then I can buy my hamburger. So liquidity is important. And liquidity defines a lot of the different measures of money. And we'll see that the lower measures of money are more liquid. So there's two primary measures of money. We'll see they're M1 and M2. In some economies we have M0. M0 is currency, and we also have other aggregates, M3 and even up to M4. But the primary two measures we'll look at are M1 and M2. These are monetary aggregates, and they help us to count the amount of money in the economy. The two primary aggregates, here we have M1, and M1 money supply. And here we're looking at coins, currency in circulation, checkable deposits. So these are also called demand deposit because it's your money, it's in a bank, and if you demand it, the bank will give it to you if they have it. So these are on-demand deposits. Also traveler's checks, something we see very little of today, but they were considered part of M1. M2 is all of M1, so we take all of this fun stuff here and we add in some other things. We add in savings deposits, money market funds. These are mutual funds that are basically in the money market. Time deposits like certificates of deposit, money that you can't touch for a certain period of time, or you can touch it with a penalty. So getting it is a little harder, and as you can see, it's much less liquid. Cards, by the way, debit cards and credit cards are not money. A debit card is a way to access your checking account. It's just it's a way to get a hold of the money over here at M1. And credit cards, real credit cards, where you're given money to use but you don't have to pay it right away, well, that's just a short-term loan. It's not money per se. For information, the ECB, the European Central Bank, then tracks the money supply. And here you see the growth of the money supply over time as it's been growing in Europe. Obviously, money grows to support the growth of the economy. Economies are growing. Well, we probably need a little bit more money to make all these transactions. But obviously, we monitor the amount of money growth to make sure it doesn't grow too fast in our economy. And this is the supply in billions of euros. So you have an idea here of the amount of money circulating. This is almost 10,000 billion euros of money. So now we'll move to the role of banks in the economy. We've already looked at this in the past a little bit, and we'll see primarily the role of the bank as an intermediary. So banks are financial intermediaries in the payment system. That helps us in our exchange for goods and services. They mediate this process. They're between the buyer and the seller. Banks help lower what are called transaction costs. These are costs associated with the transaction of buying something, which can be quite high. They also facilitate the transaction costs of borrowing money. Finding somebody to loan you money can take time. Well, banks are a central place to do that. So they lower the transaction cost of finding a lender if you want to borrow money. Banks serve as thus an intermediate between savers. Savers place their money in the bank. The bank then loans the money to people who want to borrow money. The borrowers then repay the loan with interest. That's the cost they pay. Banks then pay back the savers through the form of withdrawal. So savers want, hey, I want my money back. And savers often get an interest. Well, the bank obviously makes money on this because the interest payments they receive here hopefully are higher than what they pay the savers. And this is a key source of revenue for a bank. The bank balance sheet. The bank balance sheet represents a listing of assets and liabilities, just like any other company out there. An asset is something of value that you own. So this is an important aspect. If you own something and you can use it to produce, and you can use it to produce something or to buy something, it's an asset. It has value. Cash, for example, is an asset. If you have cash, or a bank has cash, well, you can use it to pay for things. It's something you own. A liability is something you owe. It's something that you don't own. Somebody else has maybe loaned it to you or something, and you owe this money back. Many people borrow money to buy homes. In this case, a home is the asset. You have the home, but you owe the money to the bank in the form of a mortgage or a home loan. This is a liability for you. And the net worth of a bank is simply the difference between assets less what is owed. So sometimes we have more assets than liabilities. In this case, we have a positive net worth. So let's take a look. We have a simple T balance sheet. On the left, our assets. On the right, our liabilities and net worth. What are some of the typical assets a bank may have? The first are loans. Loans is our money. If a bank loans money to people, well, they're loaning their money, and other people owe it to you, or owe it to the bank, pardon me. So they owe that to the bank. It's the bank's assets. They've loaned it to people, but it's really their money, and you have to pay it back. Government securities. Sometimes a bank will go to the government and say, hey, I'd like to buy some security, a bond. This is government issued paper. And they give the money to the government. The government gives them a piece of paper that says, hey, this is an IOU. We'll give your money back at a certain time with interest. So the bank holds these pieces of paper, these bonds, government securities, and the government must pay them back their money when the bank comes back with the piece of paper. The piece of paper has value, and if the bank asks for its money back, the government has to give it back. And reserves. This is cash on hand, we say. It's readily available to give to people that need money, and this includes what's called minimum requirements. Banks must have a certain amount of cash on hand. This is called a required reserve, and the central bank fixes the amount. It's often represented as a percentage of demand deposits. So if we have a certain amount of checking accounts, we have to keep a percentage of that in cash. Now you can imagine if all the people with checking accounts said, hey, I want all of my money back, the banks don't have it. The banks are using your money to make loans, and they're investing your money in securities. They don't keep everything in the form of cash. That would just be bad management. Its liabilities, well, demand deposits. You go to a bank, you open an account, you create a demand deposit, meaning you deposit your money in the bank. The bank takes their money and holds it in the form of cash or invests it or loans it out. But the bank owes you that money. That's your money. It's a liability for the bank. And obviously, the difference between assets and liabilities, net worth. So let's take a look at a typical balance sheet, and you can see everything balances out. That's why it's called a balance sheet. We've got over here 10 million that's been deposited in demand deposits of our customers, our bank customers. We've taken that money. We've kept 2 million in cash. We've got 4 million here that's outstanding. We've got 5 million in loans, and our net worth is 1 million. We have 9 million in assets. We have 10 million that we owe, so we have a net worth of 1 million. We probably have this 2 million from other sources of cash that we had on hand and not in the form of demand deposits. So what we want to do now is take a look and see how banks create money. And this is a very interesting aspect of the financial system we have, and it's interesting to see how banks create money. So let's take a look at this and see how it's done. We'll go back to the balance sheet, and we'll go to my bank, and I put my name on the bank. I'm very proud of my bank here, Dan's Bank, and we're going to study how what happens if I have excess reserves. I've got reserves, I've got cash sitting around, and I've got more than enough money. So let's put my bank in this situation. I have assets, liabilities. I've got reserves of 10 million because somebody has come and given me 10 million euros in demand deposits. Now, I would not be a good manager of my bank if I kept all that cash sitting around not earning interest or not being loaned out and earning me interest as a banker. So I have to decide, how much do I keep? Well, the central bank, the European Central Bank, will determine amount of required reserves that I must keep in the form of cash in case these people over here want some money. And the required reserve ratio in this case is, let's say, 10% of total demand deposits. So the minimum reserve that I have to keep would be 1 million, pardon me. So I have excess reserves of 9 million. I don't need to keep that in the form of cash. I only need to keep 10%, which is 1 million, or 10% of 10 million. So what I'll do is I'll take that money and I'll loan it out, because that's how my bank can earn money. Also note that in this simple example, remember M1 included the amount of demand deposits. So M1 in this example is, for the moment, just 10 million. So what happens? Well, I get smart. I take the 10 million and I tell myself, I'm not going to keep that on reserves. No way. That's just crazy. And I'm going to loan out 9 million of it, because I can make money that way. And I'll keep 1 million in reserves in case the people that demanded put their deposits over here come back and say, I want some cash. Now, what's going to happen? The money is loaned out to, let's say, some other person, Sam or Fred or whatever, and they've got suddenly 9 million in a loan. Well, you don't walk around with 9 million in your pocket, and so the person who has received this loan will probably go to another bank, and they're going to deposit that money in, let's say, Sam's bank. So I give the loan to Fred. Fred takes the 9 million that I gave him. Here's Fred, and Fred runs over to my competitor and deposits the 9 million in Sam's bank. Sam now has this in the form of cash as a reserve. And Sam is a smart man as well. And Sam will say, I have 9 million in reserves. That's earning nothing. I am going to loan out some of this money. Well, how much will he loan out? Well, he'll loan out 90% of it, because the required reserve ratio is 10%. So he'll keep 10% in reserves, and the 90% he'll loan out as well, just exactly like I did. And so, well, 90% of 9 million, or 8.1 million, will suddenly be in the form of loans and be given to somebody else who will go to another bank and deposit the money, etc., etc. So, what's happened? Well, my excess reserves, which were 9, were loaned out. Suddenly, the second bank only has to keep 900,000, or 10%, and can loan out 8.1 million. So with the excess reserves, I've expanded the money in one round by 9, but that's not the end of the story, because we see that the other bank is going to make another loan, and demand deposits will increase again. The second bank, in this case Sam, loans out 8.1. The 8.1 is taken to another bank. They put 10% in reserves and loan out the rest. This second bank again will take 10%, put it in reserves, and loan out the rest. And this just keeps going and going and going. And so, because the required reserves are not 100%, every time somebody puts money in your bank, you can loan it out, and then they put it in another bank, and they loan it out, etc. Where does it end? Well, it ends when we get to about 90 million. So we started with $9 million in excess reserves in my bank, which I loaned out to somebody. They deposited it, they deposited it, they deposited it. And the total change in M1, and this is a mathematical series, is going to be 1 divided by the required reserve ratio. So in this case, we're dividing by 10%. And so my initial increase in excess reserves resulted in the creation of 90 million euros. And this is called the money multiplier. Now there's limitations on this process, obviously. The state of the economy may imply that a bank may want to hold more reserves. Well, why would I do this? If the economy is in a recession, if we're in a situation of a recession, I have a serious concern because to operate my bank, I need to have people pay their loans. Otherwise, I have no incoming cash to give back to people, etc. If people are in a recession and lose their job, they can't pay their loan, and that puts my bank in a very delicate situation. So I may want to hold more reserves. Secondly, because people sometimes desire to hold cash. People like taking money, putting it in their house, under their mattress, inside books, because they don't trust the banking system. It's removed from circulation, and so we have a hard time calculating, well, if we expand reserves by a certain amount, well, what's going to happen to the final end? What's the impact of the money multiplier? Well, it won't work because there's a drain on the system. Money is escaping the system. The multiplier effect isn't as big as we think it would be. The loan market obviously is critical. Limitations on the system is based on the trust that exists in the loan market. And if assets of banks decrease in value, well, they have less to loan. They can't loan out money to create money. More money, pardon me. And obviously limitations on all of this is based on the trust in banks and the risk of bank loans, bank runs, something we saw in Greece, where the Greek economy started to tank and everybody ran to the bank. And this is why we call it a bank run. There's a run on the bank, and people ran to their banks and said, I want my money. And the bank realized they don't have that much money because they're not required to have that much money. And they immediately closed the doors and locked the doors. Bear in mind that essentially banks are required to insure your deposits up to 100,000 euros. If you have more than 100,000 euros in a bank, it's not really insured by the bank. So here we've come to the end of our session on banks and banking. You've seen what a bank is. You've discovered the different aggregate and monetary aggregates that exist. You've also seen how money is created. If a bank has excess reserves, those excess reserves can be loaned out. That loan then is given to somebody else, or given to somebody who deposit in another bank. Demand deposits increase, and that's the amount of money that we have access to buy goods and services continues to grow and grow, following the effect of the money multiplier. If you have any questions about what we've discussed today in this short video, please feel free to contact me. I've done my best at using my pen. I'm not a great artist, but I hope I was able to communicate some of the key concepts of money and banking to you in this third special lecture today. I wish you all a fantastic day and hope to see you again in the future.